taking a look at any measure of policy, trade, economic uncertainty, you're talking about standard deviation events that range between 3 and 5. Like, it's always an uncertain world, but we are an uncertain world right now on steroids. What does high, rising, elevated uncertainty mean for investors? The fact that we're on the precipice of a global trade war. So the uncertainty really stems from, we were told, what do we do? Do we take Donald Trump literally, seriously, or both? If you remember back in Trump 1.0, we were told to take the president seriously, but not literally. And now we're finding out that we have to take him both seriously and literally. And so the tariffs on China, the tit for tat there, that's just rewriting chapters of a book of this economic war that's been going on between the US and China for many years now. But the trade war being unleashed in North America, Canada and Mexico, especially what it means for the auto sector, is huge. So I think the uncertainty is related primarily, but not exclusively, to the trade side and how this is all going to play out. And then the other layer of uncertainty is on fiscal policy. Circle March 15th on your calendar. Are we going to have a government shutdown? We have really a dysfunctional Congress, almost split evenly between the Republicans and Democrats in the House. And I'm not so sure that the Senate version and the House version of the budget bills are going to mesh together. Will they mesh together in time to avoid a government shutdown, which would just be an added complication to the economic and financial market outlook? There's a chance that this time around we won't see a rescue at the last second. But even on top of that, we don't know by the end of the year whether or not the president is going to manage to prevent the economy from falling off the proverbial fiscal cliff, because many of the provisions in the 2017 tax relief bill sunset at the end of this year. And if they're not extended, that will be a massive fiscal drag on the economy. So that's why Donald Trump needs all these tariff revenues. Now, he's couching it in terms of national security, but he needs to find money. That's why Doge is doing what it's doing. He needs to find money to prevent deficit projections, as bloated as they are, from going up even further, because he wants not just the tax cuts to be extended, which are massively costly. I mean, you're talking, $4.5 trillion of additional deficit projections for the next 10 years just from not allowing the 2017 tax cuts to sunset. He's got to find money for that, let alone all the other goodies that he was campaigning on last year. No tax on tips, no tax on Social Security, free root beer and the water fountains at every school in America. I mean, you name it. So the fiscal outlook is also very cloudy. And that's a distant second, I'd say, to what's happening on the trade side. And then, of course, we had one shock a couple of years ago with NVIDIA and massive shift in the technology innovation curve that propelled the stock market to back-to-back years of 25% price return gains. And then we got DeepSeek coming out of the shadows in China, and all of a sudden creating some uncertainty as to, how much of this capital spending has already been wasted in terms of investing around this theme. Not that the theme isn't valid, but the question is, what sort of overinvestment's already taken place? So that's added in another layer of complexity when you look at the stock market, especially since it's as dominated now by technology as it was back in the late 1990s. We're going to have a few months where we're going to see some significant increases in the CPI, the core CPI, the PC deflator, the core PC deflator, producer prices. We are going to have an initial inflationary shock. The question really is, how big will it be? But you're 100% right. It will not be long lasting. Only long lasting insofar as if Trump continues to increase tariffs over time, it becomes like a repeated shock, like what happened with OPEC and oil back in the 1970s. If OPEC had just done one level shift in 1973 on oil, we wouldn't have had practically a full decade of inflation. The reality is that OPEC kept on raising oil prices every single year for an economy back then that was totally dependent on foreign oil. And that's how you got the inflation spiral. And then the inflation ended when OPEC stopped raising prices in 1979, 1980, but only after boosting them tenfold. So you look at tariffs, a one-time price level shock, probably will take place over a few months. It'll freak out some people in the bond market. I think it'll be a great buying opportunity if it does. But it's a matter of the historical record is that the impact on aggregate demand is hugely negative and overwhelms the initial inflationary shock. So you get the inflationary shock, you get that coronary on the inflation numbers, and then it comes crashing right back down because the impact on spending, on demand, far outlasts that initial inflationary impact. Don't forget that the added impact of the uncertainty. I mentioned the auto sector. Is Trump going to be applying a tariff on all the parts that flow back and forth between Mexico, Canada, the US, through Canada again, through Mexico again, into the US? It's going to be an administrative nightmare. Like, it's going to destroy the entire North American automotive industry and all the spin-off and multiplier impacts to other industries, both in the product sector and in the services sector. Nobody talks about that. The risk is from, say, your comment about will the inflation be temporary, and this is what the Fed is waiting for. You see, because it's not as if these tariff increases are coming at a time when the unemployment rate is 5, 6, or 7%. It's coming at a time when the unemployment rate is 4. What's on the Fed's mind in terms of this becoming more of a long-lasting inflation risk, this is not my view, but this is a risk around my view, based on what you said, probably a risk around your view too, is if the inflation shock, if the tariff shock feeds into wages. Well, that's a different kettle of fish altogether. That's what could lead you into a wage price spiral. And after the Fed got pasted for transitory and got it wrong, at least for an 18-month period, and apologized to the nation for it, and knowing that Jay Powell has barely a year left in his tenure at the Fed and is going to want to protect his legacy, they're going to be on the sidelines for quite a while. I think that they'll be cutting rates in the second half of the year, much like they did in 2019, under similar circumstances. But they're not going to move that fast to save the stock market. That much I can tell you. There is no Powell put on the stock market right now. They'll want to see evidence that the second round impacts on inflation from the tariffs are not coming through. And we'll probably have a good idea about that, I'd say late spring, early summer. We'll have enough evidence that they'll feel more comfortable at that point to start cutting rates. But the labor market and the wage response are going to be the real keys to what the Fed is going to be doing or not doing in the second half of the year and beyond, and the bond market outlook as well against that backdrop. Look what the Fed did. It was almost a classic case of cognitive dissonance. As they were cutting rates 100 basis points, they were talking the market out of pricing in more rate cuts down the road. And I was asking the question at the time, why bother cutting rates if you're just going to talk the market out of pricing more in? It wasn't because of fiscal policy, and it wasn't because of anything else. It was because the market, we got down to 3.6% on the 10-year note back in September. When the Fed started cutting, they cut 50 basis points. That was a jumbo cut. People were saying, well, the Fed policy is not working. No, that's not accurate at all. They basically, as they cut, they started talking hawkishly, and that's what the market responded to. The market responded to the words. And now we're priced for almost 2 once again, and we've gone from 4.70 the 10-year note, down to 4.25. Now, in terms of Doge and the cuts, I totally agree with you. There are not a lot of crumbs in the cupboard that we're going to have big fiscal savings coming out of Elon Musk. You talk about the waste is there, the fat is there, but in dollar terms, it's not that big. You want to attack government spending, then you want to start attacking the state and local government, because that's where most of the employment, not the federal government. People don't even know that. I have to show them the data. But then again, cutting state and local has no bearing on what the national fiscal deficit in Washington is going to be doing. So I think you're right. That's why. Why is Trump so aggressively on this tariff file? Under the disguise of national security, because he needs the money. It's much more palatable to have foreign economies defray the cost of the U.S. fiscal deficit. He's got some ambitious agendas. By the way, the first one is not fiscal stimulus. The first one is avoiding a fiscal calamity on the economy if those prior tax cuts are allowed to sunset. You can't let that happen. We'll have a huge recession if that happens. Well, you can't touch entitlements. You can't touch debt service costs, although he may try to do that because there's already talk about this Mar-a-Lago Accord that Scott Bessent has secretly been discussing about getting some countries to agree to a debt restructuring. But you can't really touch interest costs. You can't really touch the Pentagon. You can't touch entitlements. What's left? Not much. The reason why the rest of the world does not have a deficit situation like the United States, keeping in mind, over 6% deficit GDP ratio. I mean, come on. Canada, the bastion of socialism, has a 2% deficit ratio. You got various so-called crises in Europe. The average OECD deficit GDP ratio is 3%. It's twice that in the United States with a 4% unemployment rate. Do you understand how crazy that is? And that's because the United States, unlike other countries in the world, doesn't have a national sales tax. Donald Trump complains about value-added taxes in other countries. That's why other countries don't have massive trade deficits and they don't have massive fiscal deficits. But the problem in the United States is the U.S. prides itself on consumerism. And there's no country on earth that prides itself and measures economic success as much as the United States in terms of one thing, consumer spending. Consumer spending is success. Income is not as important. And that's why the U.S. runs up record trade deficits, is because the U.S. spends more than it earns. There is no easy way out unless you find revenues. And the U.S. is loath to raise taxes. I think the last president that dared to raise taxes was George H.W. Bush. So there's no appetite for higher taxes in the United States. So they have to find a way to cut spending, but there's no attempt for any means testing, raising retirement age, anything that actuarially could make a very big difference on those long-term deficit projections. Nobody wants to basically take the tough medicine like Canada did in the 1990s. And nobody believes in shared sacrifice. So that's why these tariffs are coming to the fore. And I think that the administration is going to be rolling the dice that this doesn't create the conditions for a recession. Because if it does, then you're going to have lower revenues domestically that will cut into the tariff revenues. But it's basically roll the dice and have the foreign producer fund these deficits. The administration seems to think that America is so powerful that other countries aren't going to respond. But the likelihood is that they are going to respond. And the rest of the world is going to get two black eyes, and especially Canada will have two black eyes, two broken legs, and two broken arms. But the U.S. will basically get a black eye. I don't remember people voting on November 5th based on, yeah, sure, I'll take a black eye in return for the rest of the world being crippled. I don't remember that being discussed, but now that's what's staring us in the face.